Please contact us if you're interested in any of our deals to get the formal documentation and request a PPM before you make any financial or investment decisions. The news with gold, it's been all over the place, and I know you've been so busy you can hardly answer my emails.
Must be selling a lot of gold. People must be lining up to get their safety, get their hedge against uncertainty of the world, right?
Yeah, absolutely. Honestly, Deanna, I mean, the bigger issue is I just want to kind of cause you a little bit of stress whenever I can. I mean, that's really why I didn't respond to your emails, just to keep life a little spicy for you.
Thank you. This is a good job for that.
My bad on that. But to your point, obviously, the precious metals market has been busy. But surprisingly, not necessarily in the ways that you'd expect. The run has been fantastic. It's been great, and yet primarily void of the Western investor.
Wow.
Yeah.
Dive into that.
Who's buying all this gold? Are this foreign investors putting their reserves into gold instead of US dollar? Is that what's happening?
Yeah, I mean, primarily what you see going on is a couple things, and that is, central bank buying is the primary driver in the last couple of years, and then investors.
Think about central banks of other countries, not U.S. central bank. We're talking about central banks of China, BRIC countries, and others. They are keeping their, I guess, central bank reserves in gold instead of U.S. dollars.
Yeah, a couple things, for that. And Mike, you're right. I mean, it is central banks, Russia, China, India, that way, that are motivated to, by policy more than anything else. They've decided, to focus on de-dollarizing and to have a reserve currency that, to have a anchor point outside of dollars. I want to, if I can I share my screen? Is that?
Yeah.
Let me see if I can do that, because that would require technology here for just a minute.
Yeah, please share your slides. Talk about McAlvany precious metals and everything you guys do. And can I have David on the podcast? He shared a lot of wisdom, and would love to. Yeah, you have wonderful slides. How about that?
Yeah, there we go. Look at that right there. I wish I could take credit for this, but anyway, what I want to show y'all is touch, if I can, just on a couple things to Mike's point. From a fundamental standpoint, we're seeing a number of different things driving the gold price right now, and the two things particularly that are impacting what we see going on with the gold price. First is that idea of de-dollarization, where particularly when we saw Russia invade Ukraine a few years back, we saw the U.S. government step in and freeze Russian assets in dollars, and in response to that, central banks globally stepped in and said, "Hey, we're not gonna, we don't want that to happen to us. We want to be outside of the dollar, and so we're going to start adding at record rates to our gold reserves, so we can keep the agency in our independence that way economically." Beyond that, or in addition to that, was the fact that last year, and to me, from an economic standpoint, was as profound of a news story as there was, that really nobody talked about, was Saudi Arabia coming to the table and saying, "Hey, when we settle oil transactions, we're going to do that with any currency you want to come to the table with. It doesn't have to be dollars. It still can be dollars, but it isn't exclusively the petrodollar any longer." And in that, there's a number of factors behind that, particularly, Mike, you referenced the BRIC nations saying that they, primarily driving this idea of de-dollarization. And so you start seeing some fundamental pieces in the gold price, that are impacting the gold price. And parentheses for just a minute, with our current administration committed to a weaker dollar policy and the push for lower rates, both are fundamental issues that will, provide pretty fertile ground for the gold price moving forward. Let me show you a technical chart, if I could, too, and this goes hand in hand. I think it's profound when we look at the gold price. This top chart here is central bank gold buying over the years. It goes all the way back into the 70s. You can see that through the 90s, particularly, there was a move away from gold reserves in central bank vaults globally. And that turned and changed at the tail end of '08 and into 2009 during the great financial crisis. And the chart below it is the gold price. And it's interesting, if you could take this gold price chart and set it on top of this central bank buying chart, you'd see that it mirrors, that they mirror each other. And
Well, recently, what it looks like, the recent activity, there's a significant,
It's tilted a little bit.
yeah, there's a relationship. It feels like there's a significant relationship in the recent, especially recent history.
100%. I mean, absolutely. It's almost like it's exactly the same chart, especially, again, from '09 to the present. And fundamentally what that tells us is that the gold price move, because I mean, one of the questions we get asked all the time is, are we at the top of the gold market, right? I mean, is this the end? Have we exhausted this thing? And the truth of the matter is, when you look at the gold price, this has been fundamentally driven by central bank demand and central bank buying. So,
yeah, I'll add one comment that what I heard from experts, and as the reliance on dollar weakens, and again, dollar has been somewhat weaponized, as you said. Instead of just reserve currency, it has been turned into a political tool, and then that concept of weaponization of a dollar essentially gives other central banks and governments a pause in, they need to find alternative. The bottom line, that's why Bitcoin has been that digital gold, and actual gold has been gold, right? Just as a way to rely less on US dollar and give folks an alternative. So that's been pretty straightforward play. So if this trend continues, that's what I heard again, the demand for gold could continue to be robust from the big players, the central banks, right? You have obviously retail investor demand, which is a different conversation. But here, it feels like, again, we are very closely aligned with the big buyers, who are the central banks, and this is the graph appears to be in close correlation.
yeah, currently. Go ahead.
Can I ask a beginner question? Does this mean, because the gold is going up in value, oil is going down in value, that our dollar is losing its value simply because the value of gold is going up and oil is going down? Not simply, but very complicatedly, maybe.
Well, inflation, right? The
Or
government.
is it correlated, or how, just because our dollar doesn't have gold tied to it anymore, right? It's
Correct.
tied to oil.
Yeah,
Now
more
they're
dollar
driving the
circulation.
price of oil down and gold is going up. And so that means,
That's a supply demand. I
Yeah.
probably, we're not experts in energy pricing. From what I do know, it depends on the economic activity, and price of energy can be volatile related to the
okay.
market demand. But this is at least in the precious metals, especially gold, it looks very, very correlated to the central bank activity. So
And
let's
supply and demand, does that mean that's why, like, they're trying to find more gold in other places now? Is that going to help with the pricing?
So, there's a number of different factors here. I mean, predominantly, though, I think, Deanna, what you're asking is, as we see a weakening dollar, that dollar gauge is marked against other global currencies. So when you start to, you hear the dollar is falling in value, or, et cetera, that's against a basket of global currencies, more so than, let's say, oil or other commodities that way. Mike's right. When we talk about oil, supply and demand plays an awful lot into the price action of oil and other commodities that way, more so than, let's say, currency strength.
But does it work that way with gold?
Basically what gold is, what gold tells us is that it's a measuring stick against the buying power of the dollar. Yeah. I don't know if I'm answering your question or not. But...
No, I'm saying, if there's more gold supply, will it bring the price down?
Oh, well, yeah. I mean, if you were to see some kind of, ability for them to pull gold out of the ground and pull it out in greater quantity, yeah, you could see that potentially happen for sure. But in part, again, the question then is, will central banks, are they going to steady their buying? Are they going to increase their buying? And then when does retail investor demand come in for gold? I mean, currently speaking, even with gold price at all-time highs, the retail investor, particularly in the United States, isn't participating. Inflows, particularly one way we gauge this is inflows into ETFs, GLD, SLV. That way, we finally started to see some positive inflows into those ETFs. And currently, even with gold price where it is right now, investor demand is below that of what we saw during the COVID recession back in 2020. So not a lot of demand yet that way. So even with more supply, there's enough room there that even if there was some more supply between central bank demand alone and the advent of retail investors coming in, gold price still has room to run.
Okay, sorry to interrupt that. Checking my SLV price now, because I've owned it since COVID. And I know that it has been down since COVID. And recently I've been watching it more because of what's happening. And it's doing okay.
Yeah. Is GLD as an ETF, it's not linked to the price of gold. It's a sort of it's linked to the producers, right? It's there. It represents how the basket of gold producing companies are doing, which is not necessarily all tied to the price of gold. It's how they are extracting gold, they're mining from the ground, and their sales and the whole thing, right?
That's right. Yeah, predominantly, that way it gives you some exposure to the market itself, but not the particular ounce itself. So
yeah, it's just for the commentary, because people can confuse, and then they think they're buying when they're buying GLD as a publicly traded ETF. They're buying gold. They're not really buying gold. They're buying a basket of producers, which could have very different performance, or somewhat different performance versus the commodity itself. And this is true for many other sectors where folks can misunderstand or confuse producer of the commodity versus the actual commodity price, and this difference in the behavior to some degree.
Yep. I agree.
With that,
let me just share a quick quote from David Rosenberg, maybe familiar to some. He was chief economist and strategist for Merrill Lynch for a long time and has been fairly successful that way, fairly profound. I enjoy his research a bunch. He made not necessarily a gold guy, more so just a market analyst more than anything, that said this. I mean, as you see here, he said, we've done a lot of technical work on gold. We think in the next 3 to 5 years, it's going to go to 6,000 an ounce. And he's got some, in this article I'm quoting from, he's got some other fundamental reasons why, but he says ultimately, but the gold mining stocks is, I think, where the really big money is going to be made. And he goes on, then the quote to the right talks a bit where he believes recession is coming. He owns his moment. He was fairly loud declaring in 2022 that we were going to have recession. And as he said, he goes, to some extent, I know this is the boy who cried wolf, but remember that ultimately the wolf does show up in the end. So,
well, it's true, because you can always say that at any point in time that a recession is coming.
You wait long enough, right? There comes a day things turn. Yes.
Absolutely. Which really, and in part, I include the quote on the recession in some ways, because having worked with you two over the last couple of years, we take information as we see it, and we make the best, for lack of a better word, guesses or observations on the information that we have, right, to operate based on what we see coming. And sometimes we're early, sometimes we're late, right? And then there are other moments where we kind of hit it on the head, and we just have to be careful that we don't get too full of ourselves thinking that we know the markets or we can call the markets, right? I mean, it's
that's true. And you also have to be careful for those people who are always saying it like it's coming, because they're always going to be right, but it's just how long until they're right, and what are you going to do in that time? That's probably what you shouldn't have done in that time. So yeah, I totally hear that 100%. There's always those people out there that are crying, the sky's falling all the time.
Yep. That the old adage that, a broken clock is right twice a day, kind of comes to mind. I think that to some extent Rosenberg, has his finger on something. There seems to be, some credence to this. To me, more than anything, this is a reminder, this quote on the recession side of things. The markets ultimately do what the markets want to do. I mean, they can outlast us, right? They can change on a dime when we're not expecting it. We can be absolutely convinced of one direction, and we wake up the next day and it's going right instead of left, and and on that way, which just ultimately, to some extent, reminds us that when we make those decisions, we have to be ready to pivot, as information changes.
It's always good to think long-term, I think, especially when you're making decisions that are going to affect you in a big way.
Yep, absolutely. So
now he's right. We think. We'll see what happens when we wake up tomorrow.
right, absolutely.
So what's on the what's he doing now? Like, have we heard about David since this, recent announcement? Does he have any new thing to say about where this gold price is going now?
Are you talking about Rosenberg here?
Yeah, like, is it still going towards 6,000? Is that what is happening?
Yeah, this is recent. Yeah, this is absolutely recent quote on gold. I mean, they're convinced that we'll see $6,000 gold. Based on, and his biggest two things that, again, one is he's coming back to the fact that the global de-dollarization in the central bank commitments of adding gold is going to drive gold that direction, primarily because when you're a central bank, once policy is set, policy drives what you're doing more so than price, right? As individual investors, price matters to us. When you're a central bank, policy is what drives what you're doing next. Okay. So he would say that, but then secondarily, particularly from a Western side of things, the debt situation that we experience and are experiencing as a country is unsustainable from his perspective, and he thinks our debt maintenance issues and the like will also drive, be a driver or fuel behind rising gold prices. So
what's
that's the inevitable thing. I mean, this is the hard part. Nobody can. Sorry, I know, Diana, forgive my interruption. You wanted to ask the date. The difficult part is when, and in the next however many years. I mean, the trend has been, and this is, I don't know, this is my thought on this. If you follow Ray Dalio's work and his study of the big debt crisis and the principles navigating big changing world order and debt cycles, sooner or later, U.S. The way we're at 7%. The budget deficit today is around 7%. For this thing to be sustainable, we need to be around 3.5%, right? That's the theory, right? To kick the can down the road long enough to be able to deal with the short-term problems. But right now, it feels like we are an extreme. 7% is for U.S. Even U.S. exceptionalism, it's too much debt. And I don't know, maybe we've sustained GDP growth and economic growth, which has been healthy, but the growth in levels of debt relative to the level of GDP growth, debt growing is faster than GDP. That's the bottom line. And in that environment, sooner or later, all assets priced in your currency devalue. By the way, Jan, you asked a question earlier, and
I was going to ask the date of this quote, and I looked it up, April 10th. So that's so recent that he said that.
Yep.
But we never say when. It's in the next however many 5 years, right? 3 to 5 years, and it's a significant bull, right? And if 3 to 5 years you double the price of gold, it's a significant. It'd be who knows, right? He can be right, or he can be right much later. If it's not 3 to 5 years, you're just gonna say, hey, listen, I was just wrong by 3 years, and so showed up in 8 years, right?
Absolutely. Part of the reason I appreciated the quote from Rosenberg is the fact, again, one, he's not necessarily married to the gold market, right? I mean, it's one thing if I come out and tell you we're going to see $6,000 gold in the next 2 or 3 years, you expect me to say that since that's what I do. But try to hold on to some guys who aren't maybe as married to the asset class like I am. So, and Mike, you're right. I mean, if he's wrong 5 years from now, we can always change a chart, right? I mean, we can always add something to make our position look a little better. So
what is he looking at?
I just got one question, sorry, and I'll shut up. Forgive my interruptions twice, so my deepest apologies.
No, it's good.
Production of gold. Do you have data on the mining? Well, what I'm curious is, what is the expected forward demand from central banks and others, and the actual supply? I don't know if you have the data. That'd be very interesting to me. Any forward projections on the price action is a function of, it's a commodity at the end of the day. It's a commodity that is in high demand as a hedge against uncertainty, against deglobalization of the dollar. But it's still, there's some kind of demand curve, right? And then the supply curve. So I'm just curious if you have any data on that front.
Yeah, not off the top of my head. It's a great question, though, for sure, Mike. And I just wrote that down to go do some research on it. What I do know about production currently is that you've got mining companies sitting in a situation right now where their average cost per ounce to get gold out of the ground versus gold price on the market today is a setup that hasn't been seen in the mining sector for some time, if at all. I mean, for instance, on our wealth management side of things, you've had a conversation with Dave McAlvany recently, but on our wealth management side of things, we have companies in our portfolio that are pulling gold out of the ground at $1,100, $1,200, $1,300 an ounce, and are able to go to market at 33, 34. And so from a baseline bottom line side, I mean that's a nice setup for you if you're a mining company.
Margin. I guess the margin is pretty significant because the price of gold is appreciated while the cost to extract, maybe there's been some inflation, but those inflation pressures have been significantly less than the price growth in the price rounds. Yeah, I mean, it's how commodities work. So it can be a great opportunity in the miners business, in the miners sector. So interesting.
Yep.
And I'm sorry I interrupted you. Let's go back to your wonderful questions. I'm so sorry for the interruption.
You're good. You're good, Mike. I appreciate it.
I forgot my question, so don't worry. Let's keep moving.
So maybe if you guys are comfortable with this, maybe we just kind of shift gears here for just a quick minute, if we can, and just kind of talk about a couple of things that I think have changed maybe within the gold market over the last few years. By and large, when people talk about gold, you hear a couple things regularly brought up about gold. Number one, it's seen primarily or almost exclusively just as a hedge, right? And it is that. And then secondarily, regularly, folks are going, hey, if I put some money in gold, it doesn't really pay a dividend. It doesn't spin interest that way. Is it something that I should be taking a position in? And to touch on that, if I can, again, I try to put it in pictures. When we start talking about gold as a hedge, sometimes I think it gets minimized when we say it's just a hedge. Again, looking at this chart, this goes back to the end of the gold standard, and you see gold versus running side by side against the S&P 500. And this isn't to say to try to say, hey, gold is better than the S&P 500, or you should get rid of any kind of exposure in the equity market that way. This is more so just an illustration to say that gold in your portfolio is more than just a hedge, that there's a growth component to it as well over time. It gives you, it does serve as that hedge, but as you can see here, when you run it in tandem with your equity position, you've got something that can bring some real growth to your portfolio over time. So,
quick question. Do you know if this graph includes dividends of S&P 500? Because if this is pure action on the appreciation, it looks like gold has done better than S&P 500 investment. And I don't know whether it includes dividends or not. If it includes dividends, I mean, that's a remarkably interesting fact. If it doesn't include dividends, then it's communicating a good message, a growth message. It's just not including the impact of the dividends.
Yeah, absolutely. That way, Mike, as I understand it, this chart was put together with dividends. I need to clarify that though. That was the request. I didn't put this chart together. I apologize. I can't take credit for it, but it was requested with dividends, so that's my assumption. But would need to clarify that.
Thank you.
Yep.
Either way, I'm still impressed because I've had this conversation with you. It's hard for me going from real estate, the appreciation and the upside of things. And I had bought, silver in the COVID run up or whatever. And I lost. I felt like I had to hold this silver for a very long time for it to get back to where it was. And finally it's making a little profit now, but it's not like as much as I would have made in real estate during that time. In my mind, it's different, right? So for me, I want to know how to allocate my portfolio and try to cover all my bases and keeping in mind, the long-term picture, but also being a young person with, my own bias in real estate. I've had a hard time wanting to put that much money into gold, especially now that it's gone up so much. And I had to sell out of some of my stuff to just break even at one point. And since then, now that things have taken off and I'm like, why did I do that? I should have held on to it. And we had this conversation, probably a year ago. And it's been, kind of like just wait and see for me. And now I wish I would have done it. And I think about that. If I would have done it and held on to it 30 years from now, am I going to look at a chart like this? You know what I mean? Like wishing I would have. So Jeff, everyone asks all the time. And I know that you have your own opinion on allocating your portfolio for metals versus, stocks and real estate and all the other investment vehicles. Do you have some kind of, idea of what would be, is, a good idea for someone who's young, midlife or older? What is the portion of their portfolio, kind of an idea?
Yeah, a couple things to your point, Deanna. Timing matters, right? I mean, when you come into a market, right? I mean, go to 2020 for just a minute. In March of 2020, well, even the difference between January of 2020 and March of 2020, right? So COVID hits, we start shutting things down. We're going to flatten the curve. There was the initial shock in the system, right? Where you saw all markets pull back, for about a 2 week, for sure a 2.5 week window at the end of March of 2020, including gold and silver. And then gold and silver kind of stabilized and they turned around and between the end of March of 2020 and the beginning part of August of 2020, silver itself, doubled in about a 5-month window. And so, it's one of those moments where if you came in at the end of March and then you were wise enough to sell or smart enough or whatever to sell in early August, you doubled your money. And you could run around at every barbecue from, forever telling everybody you doubled your money in silver. Okay. But the fact of the matter is, if you invested in January of 2020 and held that silver to the same time frame, you didn't double your money in 2020. As a matter of fact, you might have, depending, only picked up 9-10% of that move because of your entry point, the premium paid on the product. I mean, so there's all kinds of variables, when we start talking about silver, gold investments that way, that come into play. But again, now to circle to your point, gold and silver, if you look at it from a investment pie chart, right? We're just a small part of what people are doing. I mean, the rule of thumb is, maybe, 5 to 10%, allocation, that way. And you start looking at that, my opinion, you don't want to just buy some gold and silver, put it in your safe and just let it collect dust. I mean, over time, you want to have that position over time. and you can wait for, as you saw on that chart that we showed from the end of the gold standard. I mean, gold price wise is going to perform because it's an indictment on the dollar, and really fiscal policy in a broader sense. But so for you and for the folks that are listening, the allocation to gold and silver is obviously dependent upon kind of stage of life and where you're kind of you're headed in some of your financial goals that way. Um, Probably a smaller allocation for somebody who's just getting started in their investing cycle because they've got a longer runway. They've got longer time to see some compounding, and they can have a bit more of an aggressive position that way. If you're later stage, let's say you're retired or you don't have that ongoing income, you can maybe have a stronger position in gold and silver because of the fact that it operates as liquid capital. One of the nice things about gold and silver is that you can turn it back into dollars anywhere. I mean, you can go to your local coin shop, you can work with a company like us. You're going to find a place to turn your gold and silver, into cash again for you that way. It's super liquid that way, and it is a nice balance to just having cash positions, right? I mean, nobody just wants to have a bunch of money sitting in a money market account. But it gives you a balance, that way. The thing I like about gold and silver currently, honestly, is if there are people who are maybe hesitant, they're looking at the economic situation and they're going, I don't really know. Is it going to go left? Is it going to go right? Should I be in public investments? Should I be in private market investments? Then when we get into the private market investments, which you and Mike know so much about, are we looking at, are you looking at equity? Are you looking at debt? Are you looking at, income? You got all these things kind of going on. One of the things we encourage clients to do right now is if you're uncertain, you take your position in gold and silver. Maybe we can, compound some ounces over time for you with some ratio trading along the way. But it puts you in a position where we see it as a high ground from a liquidity standpoint. And from that high ground, now you can look at the markets and go, okay, here's now we see a value opportunity. I mean, you had the picture of the offering that y'all are doing in San Diego, and got my attention. And I, from somebody with some gold and silver, maybe they look at that, they can do some research. They know they've got the high ground of liquidity. And if it seems to make sense into their moment, now you're moving from gold and silver. Now you're buying into, an offering through Tempo in San Diego. So.
Yeah. I'm sorry, I'm getting live questions text to me. So if you see me look over, it's because people are chiming in on this conversation right now. Is there a real difference in the value of holding physical gold or silver versus paper?
The biggest difference is that generally speaking, with paper positions, again, GLD, SLV, you have exposure to the market, but you don't have the ounces. To invest in physical ounces that way, through a company like ourselves, we're going to allocate, whether it's in qualified funds or non-qualified funds, those physical ounces for you. You've got more autonomy, more agency that way. And so that's the primary difference between paper and physical.
But by the way, I have a couple of quick comments on things you said. It's just kind of dawned on me, and I thought about this, and I don't know how much of this is anecdotal or how much of it is logical. Earlier, you said that most of the price action, well, the appreciation in the price of gold has been driven by central banks buying gold, not by the retail investors in the United States, as an example, probably around the world. And the easy and obvious answer, especially the last couple of years, has been because the interest rates have been high. So people have parked their cash in money market accounts. And it was a very different picture when the interest rates were very low. Then the motivation was for retail investors to take the money out of low yielding money market accounts and move it to something else. Then the gold on a relative basis looks attractive. But what has transpired is it's been central bank driven rally versus retail rally. So kind of interesting. And then the other thought process, it's a great liquid asset. And you also talked about this, that you shouldn't just go buy a bunch of gold and you're done. This is not how it works. The whole theory of investment needs to include diversification element. And one of the most important diversification many of us have missed, and including the recent years, diversification in time. Diversification in time element continues to be one of the most important elements. You just don't know how to time the market. Exactly what you said. I'm just reflecting on your comments. If you time the market perfectly, you're the wisest of the wisest men. And if you didn't time it, you could look like an idiot. So the point is to avoid that risk of a crystal ball and trying to predict. Just do, if you want to buy your ounces over a certain amount of time, do dollar cost average, continue to buy over time, and don't worry about where the market goes. If you have an objective, like you said, strategy is more important than execution because you don't know what's going to happen with price. So that comment is very important. And the other final comment, I'll just kind of move to this, is let's go back to the deal we talked about. It's a relative value, right? So we know what has transpired in commercial real estate. The market has seen higher for longer interest rates, and the valuation softened up a lot. So what you have is an interesting economy where certain asset classes have done remarkably well, like gold, crypto, even stocks, right? I don't know how to value gold, right? I don't have an S&P 500 PE ratio. This is the difficult part. That's why I said about supply demand, because if you're trying to apply some kind of quantitative analytical thought to it, you look at data, right? And data, when you look at S&P 500, the PE is over 30, feels to me relatively expensive, while commercial real estate is relatively inexpensive. And the opportunity to invest in commercial real estate appears to be attractive on a relative basis. I don't know how to do it with gold. If central banks continue to consume a lot of gold in the future, right, they can drive the gold to the $6,000 in 3 years, right? It's a possibility. Yeah. So I don't know if you have any comments on this. It's kind of like all the things we talked about: diversification in time, relative value, building your portfolio, having a purpose, a strategy. You want to accumulate so many ounces of gold and silver. We haven't talked about gold versus silver versus platinum, which is another element which we haven't talked much about it. Well, platinum appears to be dirt cheap relative to gold. I remember platinum was $1,800 an ounce when gold was $1,000 an ounce, and now platinum is back, below $1,000 an ounce, and gold is over $3,300 an ounce. Kind of insane how cheap platinum looks relative to gold.
Mike, I'm going to hire you to talk with folks about platinum because you just hit it on the head. Platinum relative to gold. The fact that you can get 3 ounces of platinum for every ounce of gold right now is, from a ratio standpoint, I'm not quite ready to say it's an outlier, but it's close. Just huge value in the platinum, side of things.
I remember you get jewelry, right? You get jewelry, and you get a gold ring, and you get a platinum ring. Oh my God, that's more valuable, right? And now a gold ring costs way more than a platinum ring.
Yeah, 100%. Absolutely, 100%. I mean, when my wife and I got engaged, I looked at platinum bands and I couldn't afford it. Platinum was too expensive. And so, she had to get a gold band out of the deal. But, Mike, I think ultimately what we're saying, and I think the three of us would agree on, as we look at investing, when we can stumble into or fall into this trap of believing we have to be right. Right. I mean, we just, when I make an investment, I have to be right.
You can't do that. You cannot. If you're thinking you're going to be right all the time, then you're mistaken. You're investing not because you can foresee future. You're investing because of the need to diversify. The need that you want to invest as a hedge against inflation. Obviously, you want to grow your nest egg, and some things can go up, some things can go down, and timing nobody knows, right? So if you think you're going to be right, you're going to be wrong a lot.
Well, all you need is a few years in the market, and will chew you up, and it will remind you regularly that you're not right all the time. And so, to me, I think for your listeners, for your investors, for my investors, one of the things that we have to take away from all of this is, you can't be. There's no such thing as passive investing. I mean, there is, but the fact is there's a conscious decision. There's a focused or intentional strategy that is needed behind a portfolio. It has to happen. And this idea of just kind of throwing something against the wall and hoping it sticks, that doesn't fly. And especially in our current economic environment, it doesn't fly. And it puts the pressure, or it puts the not the pressure, but the value or the weight on working with really good operators too. I mean, you've got to work with really good people.
That brings me to a question.
Comment. No, sorry, go ahead.
audience member asked, what questions or information should I be looking to get to make the right decision on who I buy from with that operator?
Oh man, great question. 100%. And we cover this over and over and over again with clients, and you know, the technical term is due diligence, right? And to me, and there's probably more than this, but to me, there's at least three questions you got to ask on every deal. Okay. Number one, how much does it cost me to get into the deal? Right. So what is it going to cost me to get started?
Minimum investment.
Yeah. Well, yeah. Minimum investment. What are the fees? Where am I going to get surprised? I mean, we can kind of go, oh, $50 here, 100, you know, 500 here, you know, and we can kind of throw that around like it is. It's a big deal though. So minimum investment, all in to get started. What am I looking at? That's number one. Number two, how do I get hurt in this investment? Where can I get hurt? And I would encourage everybody to ask that question. I mean, you got to know. I mean, you know, you can talk to the advisor or the operator. They're obviously 100% in what they're talking about. You know, I guess parentheses, if you talk to an operator or an investment advisor and they're not 100% into their investment, it's time to go somewhere else. But they're going to be all in, but you want to ask them straightforward. How can I get hurt here? So that's number two. Number three, how much does it cost me? And how long does it take for me to get out of this investment? Okay. Because not everything operates the same. Again, for instance, public market investments versus private market investments, the liquidity landscape is different between it. I mean, you clearly outlined that, you know, for instance, San Diego, I think on that screen, I think you said 5-year hold. Yes. on the screen, as compared to a stock, which is T+3, right? You know, trade plus 3 days and you have cash. Completely different deal. But you got to understand that before you get in. And so, you know, and then I would honestly, a fourth bonus question is I would look at the advisor or operator, and I would just say to them, what is it that I should be asking that I didn't? So
I love those questions. And I feel like they're the same questions people should be asking about every investment that they're making.
Yeah, 100%.
And I'll let a few comments. Yeah. I have a book coming out. I've been writing for multiple years. It's one of these characteristics when people compare investments. Of course, you have public market investments, which is, you know, click a button, buy a stock, and it's by the way faster than 3 days. Used to settle in 3 days. Now it's literally, most of the brokerage houses will give you access to cash. If not same day, next day, right? If you have a margin account, you'll have it same day, right?
Yep.
Not only that, you could borrow against your assets, right? If you have a margin account. Yep. The other element of it is the moment you go outside of public markets, whatever it is, any private investment, whether you're buying a business, shares in the business, investing in a private real estate deal, syndication fund, those investments are generally illiquid. Like you said, gold is a liquid investment. If you hold either some kind of public, or it can be turned into cash, because you could take your gold bars or gold coins and go to a reputable dealer, and they can or maybe they're storing it for you, and they can liquidate fairly quickly depending on the market price, right? So all that is a huge benefit of public markets, including precious metals. The alternatives, of course, work very differently, and most people don't understand it, and it's vitally important to really, really understand how alternatives work. And the other thing you said, and I've been watching a video by Howard Marks, the founder of Oaktree, about risk. And most people don't really understand risk. There's risk in everything, including risk in buying gold. The $3,000 an ounce central banks can start dumping gold. I don't know, some changes. The world order can change. There's, of course, risk that anything can go down, anything can go up, and it's incredibly difficult to assess the risks of each investment, but they exist. And most folks should at least go through their own thinking process. And absolute portfolio composition is what we talked about. Like you said, 5% of portfolio, 5 to 10% could be in gold, based on your view of the world. Another person can look at it, for my circumstances, I need to have 20% in gold. Another person could look and say, I don't need so much gold because I have liquidity through other mechanisms. And same, by the way, same applies to private investments. Some folks load up in private and they don't have enough public, and when they need liquidity, they can't get it, right? It's a different ball game. So long story short, one of the sort of lessons learned, folks should absolutely look at their investment portfolio compositions and the role of each investment or investment class in their composition. This is not investment advice. This is just educational thinking through what does it make sense. And it's different to you. It's different to Diana. It's different to me based on individual circumstances. And that's what most people miss. But I do want to add, part of the process is deep due diligence. Like you talked about due diligence, vetting operators and brokers and folks that offer you whatever the product is critically important. And you have a however many year history of the organization, right? That helps. If people have been around for long enough, that's an attestment to some level of longevity and knowledge and expertise. But continuous due diligence is a process. So I'm going to shut up for a second, go back to the questions. But I wanted to outline, respond to your questions that these due diligence questions are vitally important and they differ. But some of them are fundamental and doesn't matter. You can apply to any asset class.
Okay, I have several comments here. First of all, I think recently I heard someone say, if you want to get, like when you're young, you want to specialize in a niche, like if you're investing, make that your thing that you really know and understand, and then you can get your wealth in that. And then you want to diversify because that's protecting the wealth that you grew. I wouldn't say that's the way to go. That's what I heard recently. I think that works for some people, especially if they know like tech stocks and they're investing in that, right? But real estate's a really interesting one because you can say that I'm very much all into real estate. Most of my portfolio is all real estate, but it's diversified among different types of real estate. So I feel like I'm a little diversified, but over allocated in one, right? So anyway, it's very technical and everybody's different on that. I also have heard recently they're switching gears here, going to politics again. China is moving into Africa. They're building all kinds of housing for them so that they can mine their gold and back the bricks. And someone actually just texted a question that they've heard China and other emerging market economies are selling precious metal holdings if they're running out of dollars. And that could cause them to sell treasuries. And they're curious how that could affect the metals market. But I'm curious because I know that they're going there to get more to back their new currency. But also if they're hearing that they're selling their metals because they're running out of money. I guess, do you know anything on this, Jeff?
Probably not enough to comment on. When I look at what China's doing, man, without going too far, down a rabbit hole on this, right? I mean, I know number one, China's dealing with economic situation right now that's just a mess. I mean, they've got problems, and they're basically, I mean, they're looking at, how do we stabilize our currency, number one, without, how do we stabilize our economic situation, number one, without having to devalue our currency more? I mean, that's a primary thought that they're dealing with. And then, can we do so without having to go saber rattle or go jump into some kind of conflict, some kind of wartime conflict? Their situation, for them to jettison dollars, they'll do that. And they've started to do that. And I think they'll continue to do that. Their gold reserves, though, they're going to be pretty slow to let those go, in my opinion. Here's one example why. In January, the Bank of China, or the Chinese central government, stepped in and said, hey, we're going to do something new this year. We're going to allow our top 10 insurance producers in China. We're going to let our top 10 insurance producers take a 1% position in gold as part of their reserves. Okay. Their 1% position takes, I forget how many tons of gold that is, off the top of my head, just 1% position. And then if this is successful, we will revisit in a year, and then their thought or their target is to increase that up to about 3% of their cash reserves for these insurance. That'd be like an insurance producer here in America. Instead of just having cash reserves for every dollar deposited, now they can have 3% in gold. and you've got a country that is already bent toward having gold reserves, and a people group really who say, hey, we're really comfortable with having gold. And so as they expand, as they're taking that foothold, I mean, what Africa really does is just allows them another way to accumulate gold, in my opinion, at lower prices if they're able to mine gold in some of these places in exchange for infrastructure and housing, et cetera.
I'll add one comment. Again, listening to a number of recent podcasts, full-scale trade war, U.S. versus China. So U.S. really doesn't have a big grudge against anyone else in the world. U.S. is really full speed ahead. All these trade wars have been directed to put a little pressure on other countries and then have them play along, be on the U.S. side. U.S. primary goal, this is what other folks have talked, is to full speed ahead trade war with China, because China is a rising power, U.S. is a declining power. We do have a massive issue that our debt has been growing at a pace unsustainable, and if we don't fight with China now economically, later we will just basically be subdued and we'll be forced to surrender. So this is a geopolitical, no weapons sort of type of a cold trade war. This is sort of that's what's happening right now. And if you basically look at countries like China, where at this point on the brink of being an adversary, Russia, right? It's the adversaries, not the BRICS, but specific countries that are part of BRICS, right? Russia, China, for sure. The adversaries, right? So adversaries don't want to buy our currency. We don't want to buy their currency. They want to buy probably other assets that are valuable. What I heard is China is not big on Bitcoin. They're not big on crypto.
Right.
They don't like it. So maybe their only path is gold, precious metals, right? Maybe that's what's happening. Same thing. I don't know. Russia may be different, but the point is, China is no longer an emerging country. It's the number one country in the world economically. So my commentary here is probably China, if they want to park, the excess trading surplus somewhere, right? They got to park it in precious metals a lot more than anything else. And of course, they're peddling influence in Africa and other countries. They've been doing that for a long, long time. So, the wars are, I remember I grew up in the Soviet Union, US versus Soviet Union. That whole thing is long gone. Soviet Union collapsed. Russia is really, a small fraction of the economy of the US. But China is close to, approaching to being on par. And Africa question, we're gonna continue to paddle. Like we're gonna continue to paddle, to buy influence, to buy resources. Anytime you have gold, silver, precious metals, rare earths, anything, right? It's gonna be who is gonna get their footprint on that and impact those governments with the economic dependency, investments, whatever you want to call it. So interesting conversation, but a ton of experts are saying we've entered a phase following Ray Dalio's principles on navigating changing world order, exactly that phase, and that's what it feels like. I don't know how else to put it. If you haven't read that, that'll make you feel like, hey, probably China is going to go heavy into gold because they got to get out of dollar and they got to peddle all the influence and reserves into something else.
One more question. You might have answered this earlier. What's the reason for the price difference between the US and Canadian, even though they have the same purity for their gold? And which one's better?
So it's about 6 of one, half dozen another. Actually, the Canadian gold comes in, especially if you're talking coins, you're going to have 4.9 fine gold. U.S. American coins are 3.9s fine that way. The primary difference in price is the fact that we live in the United States, and as United States citizens, we're going to pay a little bit more premium for what we make in our country. There's a little more supply and demand features that drive the price on American Eagles versus, let's say, a Canadian Maple Leaf, that way. So
is it the same weight, exactly the same everything?
The same weight, just a shade difference in purity. That way, the Canadian government does that 4.9s sides that way. What's crazy is too, sometimes things come in and out of favor, Deanna, in the sense that when gold was legalized again for citizens to own back in the 70s and early 80s, the South African Krugerrand was the coin of choice. Everybody bought a South African Krugerrand, and now you can get into a South African Krugerrand for below a gold eagle by several percent premium. because very few people are looking at them right now. So, I mean, again, supply and demand features, but to the question, the primary difference is that, I mean, if we lived in Canada, we would probably pay a bit more of a premium in Canada than we do, for a Canadian maple leaf than an American eagle.
If the gold it travels across the border, is there a tariff?
That's a great question. And with we have a partnership with the Royal Canadian Mint, where for our online gold buying, silver buying app called Vaulted. Right now, our clients can still take delivery of full kilo bars out of the Royal Canadian Mint, and there has been no tariff at this point.
So as they said, do they have to travel to Canada, pick up their gold, and then go across the border with their gold bars? Because I haven't thought about this, but it's kind of, if there's a tariff, right, and the goods is coming over, is gold, silver, anything impacted? Like, it's kind of weird, but.
Well, even
currently not a problem, that way, but we've not run it, but that doesn't mean that doesn't change in time. So something we're monitoring for sure.
Wow. I was going to say, maybe because they want the gold here, they don't want to discourage you or tax you extra to just bring it here, because then it would be here.
Yeah.
But even water, like, are they going to tariff water that comes across the border? I don't know. Like, are we importing water? Fiji ships their water. I mean, I don't know. I'm just saying. Okay, well, I mean, this hour flew by. I am really shocked that it's already been over an hour. Thank you for your time, Jeff. I want to put up your contact information. Do you have a slide that has that?
Yeah, I do.
I want to make sure that people reach out to you if they have any extra questions, because your firm helps people that want to invest in precious metals. And can you explain what you do in your firm, like a real quick overview of what your firm does?
Yeah. I'm gonna share my screen here real quick so that we've got. I appreciate you letting me do that. I don't know, did I get that shared?
I saw your name on one of the slides earlier, but I want to make sure people have your phone number, your email address, and then if
there we go. Did I get that right?
If you have any last questions, go ahead and put them in the chat. We'll get them answered really fast. But this has been really cool information to get. The timing is just really interesting. So basically, you're telling me, Jeff, based off of that guy who was wrong, I should be investing in gold, and in 3 years' time, probably going to double my money.
Sure, absolutely. And if not, Deanna, when we sit down together, I'll buy dinner.
Awesome.
So,
I was trying to buy your dinner with Mike's card.
Well, there you go. We'll do it. Well, you know what? We'll make Mike and Dave McAlvany pay. That's how we'll make it happen. But to answer your question real quick, I mean, what I do every day is, as a part of being part of the McAlvany Group, 52 years in the business. By and large, what we do is we sit down, we evaluate portfolios, we make recommendations to clients, based on their goals and their targets as to how to best implement physical gold, silver, platinum, and palladium into their accounts. We spend a lot of time talking about ratio trading. That's a conversation for another time. We do it with qualified funds and non-qualified monies. And, we work and interact with clients in an advisory capacity that way. So that's what we're doing.
Well, let's plan that other time for the ratio trading discussion, because I need to learn more about this stuff before I make this big investment, because I'm going to be, so rich in 3 years. Jeff, thank you for your time. I really appreciate it. And thanks everyone for joining us today. We will be back in June with another webinar, lunch and learn topic. So keep an eye out for our emails and make sure you register, share this with a friend that you think would be interested, and don't hesitate to reach out if there's anything else that we can help you with. I hope everyone has a great weekend and a happy Mother's Day, and take care. Thanks everyone.
Happy Mother's Day.